Two of the greatest tax benefits that we have in this country. One is the small business deduction that we just talked about. Huge advantage to the small business owner making up to $500,000 and passive income less than $50,000. Huge advantage. The other huge advantage is the capital dividend account. So how many small business owners know anything about the capital dividend account? I talked to many, and very few know what it is. Some have heard of it, some have not. Yeah. Very few actually understand it. So the capital dividend account is the second greatest advantage that we have here in Canada regarding taxes, especially with a corporation.
Today, we're just going to break down what passive income actually is, why Ottawa changed the rules, how a 50,000 threshold works, what happens when you cross it, and some planning concepts business owners should at least be aware of. Examples of active business income, you're selling products, you're providing services, you're in the construction business and you're constructing, you're farming, you're consulting, you're running a clinic, you're running a trade business. All of that constitutes active business income. That's fairly simple. Now, the trick here is that in the eyes of CRA, you also have passive income, and that would be things like interest on investments, GIC income, rental income, portfolio dividends, capital gains.
So the reason that it's important to understand the difference between active and passive income inside a Canadian controlled private corporation is the way it's taxed. So that is what makes all the difference. So in 2018, the government introduced new rules for corporations and how they're taxed. And the impetus behind that was they wanted to make taxation fair between business owners and typical T4 employees. So they felt like T4 employees were being taxed more than business owners. And one of the key reasons to have a business is for the tax advantages, right? Liability is one. Liability protection is one big reason to incorporate. The other is for taxation. So inside a corporation, you can have a lot more control over your taxation. It is tax deferral. It's not tax avoidance, it's tax deferral, but you have control on when you can determine you want to defer tax or not defer tax.
So when you declare an income, when you declare a dividend or whatever, right?
Right. So if you want to take money out of your corporation to use it personally, then it's taxed personally. And inside the corporation, it's taxed as a corporation. And then you can decide when and if you want to take that money out of the corporation. The key point there is if you have money left inside the corporation, right? Retained earnings is generally how it's termed. If you maintain retained earnings, you have profits, then you keep them inside the business. They are taxed differently than that active income that you're the key part of your business, what you actually do, that income is taxed very favorably. So it's a huge difference, and it's important to understand. So one of the key benefits of a private corporation is, as you mentioned, the small business deduction. So all income, all active income up to $500,000 per year receives the small business deduction. And the difference is with the small business deduction, you're paying anywhere from 9 to 12% tax on that first $500,000. Anything above that, you're being taxed at anywhere between 23 and 31%.
And we're saying those ranges depending on the province.
Correct. Exactly right. It all depends on what province you're in. So the tax rates are different in each province. So that makes a huge difference. And the whole idea behind the small business deduction is so that small businesses can flourish. And it helps our economy. It helps everyone. if our small business community is flourishing, profiting, hiring, spending, it's the backbone of our economy, right?
Well, it's about 90% of the employment in Canada is provided by the small businesses.
Exactly. Small to medium
Yes.
businesses. Exactly right. Excuse me. So it's key, right? And that's the whole impetus behind the small business deduction. But in 2018, they changed the rules. So if you retain your earnings and keep them inside your corporation, whether it's sitting in a savings account, whether you invest that money into something or whatever, whatever it is, if it's passively earning income, it's not part of your active business, but it's a passive income source, that is taxed at 50%. So
It doesn't matter. Like there's no brackets. It's 50 right
no,
away.
yeah, I mean, each province is slightly different, but generally speaking, it's very close to 50%, either slightly under or slightly above, right? It's very close to 50%. So all that hard-earned money, you're growing this business, you're working hard, you've got some profit, you have retained earnings. That's awesome. That's excellent. But now the government can take 50% of any growth on that money. It's
It's
insane.
punitive. Well, it's
Absolutely.
yeah, yeah. And you have
Absolutely.
to think in a capitalist society. I mean the way like the economic engine of any country and a huge reason why we have and enjoy the standard of living that we have here in North America, it's because the small businesses. So these are your entrepreneurs. This is the people solving problems, making your life easier, making your life more comfortable. They are the reason why. So in in any state, any government that there's always like a fine line between how much taxation they allow and how much and how punitive that is. Like it's always like a fine line, because if you are to tax that sector of the economy, those creators, those service providers, if you are to tax them too much, they just leave,
Yeah.
right? And again, we're saying 90%, close to 90% of the employment in Canada is provided by the small businesses. So you definitely want to keep them happy. And in 2018, it was one of those steps where it didn't make it easier for any entrepreneur to say, "Hey, I want to do business in Canada." Apart from that, we have been having talks about increasing the capital gains inclusion rate. Also, that's still up in the air. So those two are like very key attacks towards that sector of the productive economy, which again is key to our welfare. So
Mm-hmm.
yeah,
So it's a punitive tax on any passive income that is inside your corporation. So it's critically important for the business owner to understand what's happening, right?
yes,
And get good tax advice.
absolutely,
The other
yes,
thing
because
is, so not only is that there's that 50% tax rate on passive income, if you make too much money passively, they start clawing back the small business deduction. So this
which
becomes
is
even
five
more
dollars, which is
punitive.
$5 per every dollar that you're above that threshold.
Yeah,
And once you get to $150,000 of passive income per year, you lose it completely. The
correct.
small business deduction.
Correct. So your
Yeah.
tax rate is going to more than double on your active income, right? So you're going to pay 50% on the passive. Well, now they're going to start hitting your active income because you made too much passive income.
Yeah. For the sin of passive income, man.
So anything above 50,000 a year in passive income, they start clawing back, right? Like as you said, $5 for every one over. So that becomes extremely punitive. So now the business owner has to think differently. How can I do this differently? How can I save more, keep more, and be able to grow my business in a way that makes sense? And I don't give half of it away to the government, or more than half sometimes. So it's extremely important for business owners to understand what's happening.
Absolutely. And another key aspect that I want to bring up is that, for those business owners that have corporate structures where you have holding companies and opcos, that doesn't necessarily shield you from this. So a lot of people think that, oh yeah, well, no problem. I'm just gonna have all my passive income inside of the Holdco, and the opcos are gonna handle the active income. Well, CRA doesn't agree with that, and so it just affects the whole corporate environment that you may have set up. So that's also good to keep in mind. So
then the question is, what can the small business owner do? What can you do differently? Because as you said, corporate structure may or may not help you. Like there are advantages for different corporate structures, and holding companies do have a place for sure. But if those companies are related, then it doesn't matter. Passive income inside a holding company will affect all of the associated operating companies. So if there's any kind of ownership in an opco with a holdco, any amount, 25% ownership of, let's say you own 50% of company A and 25% of company B, your holdco has passive income. Well, that affects both operating company A and operating company B. So that's also very, very important to understand. And you can't get around this problem strictly only through corporate structure.
exactly. So as you can see, George, there's also so by doing this, there's an incentive for the business owner to reinvest their return earnings in active business operations, right? And that doesn't necessarily most of the time it should be like a good thing for you to reinvest your return earnings into the operating side of the business. But on the flip side, like the other side of that coin is that as you do that, the business might be getting more dependent on traditional financing channels, because if they have to reinvest those return earnings into operations, then those return earnings and that liquidity is not as high as you would have that into investments or generating that passive income. So that's also something that's often disregarded, but it's a reality where the business owner it certainly won't have the same level of liquidity if they are actively avoiding that passive income.
Yes. Yeah. Now, just to go back a little bit on how the passive income is taxed. So that income is taxed at around 50%. Now, there is a tax that's refundable when you pay dividends.
Mm-hmm.
So the RDTOH, what does that even stand for? I'm not even sure. But anyways, it's basically a refund of taxable dividends that the corporation and or the individual can receive. So integration is designed so you don't save tax long term. You're just going to just defer it. And the other thing is that this isn't a broken system. This is actually how it is designed. So it is designed to remove the advantage of investing passively inside a corporation. Now, you may or may not agree with that, and we certainly don't like it, but this is actually how the system is designed. So what we have to do as advisors and as business owners is really understand what's going on, some of the common mistakes that business owners are making, and then what are some potential solutions that we can avoid some of this punitive tax that we work so
The whole idea behind this is it's integration, right? It's tax
exactly.
integration. And
Yes.
RDTOH stands for refundable dividend tax on hand.
Thank you.
That's what it stands for. But it's curious how, instead of doing integration, if the business owners already had the advantage to retain a way more of their passive income before 2018, then, why don't do the same for the individual and have the individual also enjoy that? It's like, well, no, it has to be higher taxes for everybody,
Mm-hmm,
And I mean,
mm-hmm,
that's valid. They could have done it the opposite, but we all know how that works.
mm-hmm.
Yeah.
So what are some of the common mistakes? So leaving excess cash sitting in the corporation without a plan is common
Hmm.
and often is not considered a mistake. But really what you're doing is you're leaving money on the table in taxation and in also in growth, depending on what that money's sitting in. So if it's sitting in a bank account, it's really doing nothing for you. Anything you earn is taxed heavily, and you're probably not going to beat inflation inside of the savings account. So depending on what you're putting that money in, it's not in your best interest. So you need to have a better plan. Also, building large passive portfolios inside the operating company is going to cause extra taxation, unnecessary taxation, punitive taxation. Also, not realizing that rental income is usually considered passive income as well. Most people don't realize that. And capital gains is also considered passive income. So ignoring any of those things, and especially ignoring how close you are to that 50,000 per year threshold, is also critical and is in your best interest to pay very close attention. Have your accountant pay very close attention. So unfortunately, success can quietly kill your tax advantage if you're not watching your passive income. Success can quietly kill your tax advantage if you're not watching your passive income. This is huge. So important.
George, one key thing that I want to bring is the fact that these rules are meant for Canadian controlled private corporations. And when you are a Canadian controlled private corporation, this is when you actually access the small business deduction. And apart from that, you also access the lifetime capital gains exemption, which are
Yeah.
two key things. Now, what would be, we covered the small business deduction, but are there also any concerns related to the lifetime capital gains exemption whenever we also have return earnings and passive income inside of a corporation?
Yeah. I mean, I'm not a tax expert, but it is important to understand because you have to qualify, right? You have to qualify, and there are a number of different rules for qualification. You have to qualify for that lifetime capital gains exemption, right? So Canadian owned, can't have any foreign ownership is one thing. Passive, active versus passive. So I believe the number is 90% of your income has to be active in order to qualify for that exemption, which is a huge factor, right? So there are different rules around all of these things, right? So it's very important to understand what those rules are and talk to the tax expert And if you don't have a tax expert, or if your tax expert doesn't really understand and is not giving you the answers that you're looking for, then find another one. So there are people that specialize in these areas, and some are good and some are bad, just like anything else, right? We have good doctors and bad doctors. We have good everything and bad everything, right? So find the right person that's going to give you the right advice. That would be my advice, but it's important to understand all those different rules, right?
Yes.
If
Yes.
you think
So
you
yeah.
qualify and you actually don't, that's some harsh news that you don't want to get.
Mm-hmm. Oh, definitely. And yeah, with the capital gains exemption plus the small business deduction, as you're saying, like this is something that as a business owner, you need to keep track of that. You need to understand how that works because that is just going to it can potentially have very, very negative consequences. I want to pivot now to the possible solutions, George, and there's more than one. There's more than one here. Those are solutions that built inside the tax code. Okay, we're not talking any loopholes, we're not talking any strange strategies or any edge cases. We're talking stuff that's well defined inside of the tax code. And one of them, for example, is permanent life insurance. Growth inside of permanent life insurance policy is one of them. Another one will be critical illness policy owned by a corporation, like split ownership between corporation and a person. And there are other advantages to such a structure for C. Another one will be the IPP,
Individual pension plan.
the individual pension plan. Yes. So those are some of the possible solutions. Could you expand on, let's start with the permanent insurance and what type of permanent insurance the business owners can use? Why would they want to do something like that? What would be the benefits?
Yeah, absolutely. So there's a couple things. So first of all, permanent life insurance, and in particular, participating dividend paying whole life insurance, is a tax exempt product. So it has tax advantages that are written right into the tax code. So it is after tax dollars that are used to put into the policy. They will grow tax free, right? There is cash value that is going to grow guaranteed, and it's going to be very tax advantaged, and it's going to be growing tax free. When you want to access that money, there's a potential for a taxable event if the money you access is greater than your cost basis. The difference could be taxable, just like with real estate, right? So when we buy and sell real estate, we sell it. The difference between the selling price and the cost basis is our capital gain. And then we will pay tax on that difference. However, there are strategies that we can use to avoid paying that tax, right? So permanent life insurance has the advantages of very similar to a tax-free savings account, right? After tax dollars go in, grows tax-free, you can use it tax-free. There are ways to use it tax-free that are legal. And the other key part there is that you have control. You decide. You're going to have all the information up front, then you make the decision what works best for you. So highly, highly tax advantaged. So when you're talking about passive income, so this is a place to put those retained earnings, that money that's sitting in your savings account doing nothing. And it's going to give you those tax advantages. It's going to grow tax free. You can use it very tax advantaged and potentially tax free. So the two of the greatest tax benefits that we have in this country. One is the small business deduction that we just talked about. Huge advantage to the small business owner making up to 500,000 and passive income less than 50,000. Huge advantage. The other huge advantage is the capital dividend account. So how many small business owners know anything about the capital dividend account. I talked to many, and very
Yeah.
few know what
Mhm.
it is. Some have heard of it, some have not.
Yeah.
Very few actually understand it. So the capital dividend account is is the second greatest advantage that we have here in Canada regarding taxes, especially with a corporation. So it's a notional account. So any capital gains tax that you don't pay, so that 50% that's not included in your income, that 50% goes into your capital dividend account. Life insurance proceeds also go into that capital dividend account. Money can come out of your corporation through that account as non-taxable dividends to your beneficiaries.
There's two sources of income that could go into the capital dividend account.
Essentially,
And those two sources of income are, number one, the proceeds of a life insurance policy, meaning when a life insurance policy pays a death benefit.
correct?
And the second one is,
The 50% of your capital gains that you didn't pay tax on. So the non-included 50%, right? So currently the inclusion rate is 50%. So the 50% you don't pay tax on also goes into that capital dividend account. And
and
that's
that can flow to the
flow out
shareholder tax
tax-free.
free.
Yes, it'll be a
That's huge.
non-taxable dividend. Yes,
Yeah.
exactly. Exactly. So this is
Okay.
why planning and having good strategies is so important, because you can plan for all of that. So you want to maximize your capital gains, minimize your other sources of income that are taxed at 50%. So those are the two advantages. So life insurance provides you the advantage of the capital dividend account. You can maximize that account tax-free. Huge, huge, huge. The other thing is that the cash. So this is an asset. So you're purchasing an asset inside your corporation. It's growing in equity, it's growing in value, but it's growing tax-free. So you're not paying that punitive 50% tax rate on anything that's inside a tax sheltered, tax exempt insurance policy, permanent life insurance policy. So you're not paying tax. So how huge is that? You're growing your capital
Yeah.
that you can access. It's still liquid capital. You're growing it. You're protecting it. It's guaranteed to grow. It's going to beat inflation. It's going to far beat any savings account or GIC. And it's going to be tax-free. So you have to consider that.
It's also shelter from market volatility. We're not talking a traditional investment here. So it's building real solid capital that you can then leverage and not liquidate.
Yes.
But that's also part of it, right? Because the next thing will be for the business owner to ask, okay, well, awesome, but how do I use it? How do I actually access that equity?
Mm-hmm. So there are ways, right? So we leverage that capital, right? You can use the policy loan from the insurance company. You can use a third-party lender. And that's how you can access that cash tax-free into the future. So there's different strategies there for sure. And you mentioned that the CI, the split cost CI with return of premium, that return of premium is going to come to the individual on a tax-free basis.
Yeah.
So there are great strategies to decrease your tax burden, avoid that 50% punitive tax rate, avoid losing your small business deduction, any of it, and get the advantages of the capital dividend account and getting that money out of your corporation tax-free.
Potentially, it will depend on, and it depends on every case, but potentially, George, the premium paid into those policies, if those are required to secure lending from a third-party lender, that could potentially be paid with before tax dollars. So
Potentially, yeah.
potentially, yeah.
There is the potential. You have to be careful. But generally speaking, they're not going to be a tax deduction, but they can be. Yeah. Yeah. So those are huge advantages that that few people know anything about, right?
Hmm.
So few people know that these strategies and these advantages are out there.
Yeah.
So many people just think that they just put their money in a bank account and let it sit there. But that is far from the most effective and efficient way to deploy your capital,
Of
because
course.
your capital has value, right? Your money, your capital has value. Why does someone else's money have more value than your money? So we have to treat it like it's capital, that it has value, and we have to protect it and grow it and then use it appropriately. So these are the kinds of strategies that we help people implement into their lives. Um, and for business owners, it's huge. It's a huge advantage that's in the tax code that for whatever reason, people don't know. Their accountants are not telling them about these strategies, and I don't understand why. Their certified financial planners are not telling them about these strategies. Why not? Right? Why not?
Yeah. I want to briefly touch also into the critical illness return of premium, because that's another winner in my opinion. Like, and essentially how, in a nutshell, how it works is that you will have like a shared ownership of a CI policy. It will be premiums for that policy will be paid 60%, usually around 60% by the corporation and 40% by the individual shareholder. So the insurance company will receive those premiums, and after about 15 to 20 years, there can happen two things. One thing, the shareholder is covered for critical illness, and in case they develop one of those specified illnesses, the insurance company pays the corporation a tax-free benefit for that CI policy, which can then be distributed to the shareholder as a taxable dividend. Okay, that's one.
Yeah. Or it can be used for the business to carry on while that individual, usually a key person to that business, is recovering.
Which
Right.
will
So
be the most efficient way of using this proceeds. Absolutely.
yeah.
And then the second way is, hey, you know what? 15 years passed, 20 years passed, and I'm still healthy. Nothing happened. Well, guess what? All the money goes back to you. It's a full return of premium back to you. And the awesome part is that the 60% that was paid by the corporation flows to the person, the shareholder, tax free. That's a huge advantage.
Correct. Now, there's no growth on that money over the years, but you will get 100% of what was paid both by the corporation and the individual. Now, this all has to be set up correctly. It has to be done correctly and stay within, CRA guidelines, but it is absolutely a viable strategy. And it is a way to get money out of your corporation tax free.
Well, and even George, and even if yeah, absolutely, there's no growth, but you're getting that money tax free from the corporation. And one key thing that's a lot of people miss out is that the peace of mind of having that CI coverage
Right.
for
Right.
20 years. Like, you show up
Absolutely.
differently in life when you have that. When you know how
Absolutely.
how you have you're being backed up by that, it's
Yeah.
huge. So something to keep in mind also.
Well, if you have a partnership, so any corporation, any business where there are partners involved, generally speaking, you're going to have a buy-sell agreement. So you're going to have an agreement. If something happens to one of the partners, one of the shareholders, what is going to happen? How are we going to protect our company? Now, it could be premature death. It could be a critical illness. It could be a disability, right? There are a number of different ways that individual can be taken out of the business, either permanently or for a period of time. How is the business going to carry on without them? How are you going to function without that key person?
Well, and the
Maybe it's
forced
the key
partnerships,
person.
the forced partnerships that also happen
Right.
when, and what do I'm talking about with a forced partnership? Well, now John is now partner with Mark's wife.
Yes.
Mark passed away, and now John is partnered with Mark's wife, and Mark's wife doesn't know anything about the operations of the business. And that's a
Right.
way too common story, George.
Yeah. So then, so we have the buy sell. We want to be able to, protect our business in case something happens to the key people. Well, then the next question is, how are we going to fund that? How are we going to fund that buy sell agreement? The best way to fund a buy sell agreement is through permanent life insurance, critical illness insurance, and disability insurance. Because all those insurances pay out tax free to the corporation so that the corporation can carry on financially without that person. So it's a huge protection. And there's no better way to fund it. It's like, how else are you going to fund the buy sell? Do you have to liquidate assets? Do you borrow money from the bank? Do you,
Well, could you even borrow money from the bank? But
maybe not. Maybe not, because now your business is in trouble because you just lost the key person.
Mhm.
So you may not have that option. You're absolutely right. And if you don't have cash on hand, like how are you going to carry on? So, the protection should not be understated. We get protection and we have all these other advantages, tax-wise and otherwise, of using these strategies and these tools. And our goal here is to let people know that these exist, because so few people know that they have these options available to them. And they've been around for hundreds of years. This isn't anything new. We're not preaching anything new. We're not telling you anything that hasn't been around for 100 years. But so few people understand it and know it because they're professionals, and the government and the banks and everyone else, none of them are going to tell you because it's not to their advantage.
it is not.
So it's about education, learning, researching, and finding out, the best option for you.
Excellent. George, I want to close this episode by making a call to the audience, to you that are there listening to me. And, you're a successful business owner. You have income flowing. Start thinking, like, how much of that can I start moving from the taxable side to potentially the deferred side, or even the exempt side of things? How much of that? And, get that conversation started in your head. And let us know if you have any questions. We'll be glad to answer that. We have a team of professionals helping us, supporting us along the way, where we'll always be able to provide you with the best possible answer to your questions. So don't hesitate.
I would just reemphasize how important it is to understand, get educated, understand what's happening inside your business. Active versus passive income. What am I being taxed on? How can I decrease my tax? How can I protect my business? How can I protect my family? So there are ways, and they're very cost effective and very advantageous. So, a lot of people look at insurance as a cost. Well, this is not a cost. You are depositing money into your savings account, if you will,
Quote unquote,
that is
for those that are not
growing.
watching.
That's right. So it's growing guaranteed, and it has all the protection that you and your business and your family need.
Yeah, you're just simply building an asset, right? It's an asset that you're building, that you leverage against. It's an asset that's built in guarantees. It's an asset that has a privileged position within the Canadian tax code. That's what it is.
Yep, exactly right.
Awesome. Well, thank you, George, and thank you for listening. And I see you on the next episode.
Thank you. See you later.
This episode of the Sovereign Capitalist Podcast was provided with the understanding that the staff and contributors of Asteris Capital Advisors are not herein engaged in rendering tax, legal, or financial advice. For such matters, please consult your own tax, legal, or financial advisor.